welcome to my channel. I'm Toyosi. In today's video, I'm going to be explaining financial statements, the main financial statements that a company is required to prepare, and just walk you through what each of them looks like. So first, what is a financial statement? A financial statement is a written record that illustrates the primary activities of a company and also shows the financial performance of this company. The three main financial statements are the income statement or the statement of profit or loss, the balance sheet or statement of financial position, and the cash flow statement. So what are each of these financial statements? I'm going to be walking you through each of them using Apple's financial statement as a case study. And as a stakeholder in a business, whether you're a lender, you're an employee, or you are an investor, you should understand how the business you're investing in or you're working for is performing. And if it's a public company, they are required to actually publish their financial statements quarterly and annually. You should go to your company's website, check the investor relations section, and you will find either the 10Q, which is the quarterly filing, or the 10K, which is the annual filing. So let's start with the income statement. The income statement actually shows how much money that a company makes over a period. It shows the profitability of a company over a specific period. Using Apple as a case study, we can see their consolidated statement of operations, and the first section is actually revenue. Revenue is the total amount of money that flows into a company from its sales of goods and services. And for Apple, we can see that they have two lines, which are the products and the services, and this gives us the total net sales. Next section is the cost of goods sold. The cost of goods sold or cost of sales actually is the direct cost of producing goods and services that were sold. So every cost that is directly related to the products or the services in the case of Apple that were sold is the cost of goods sold. So when you deduct the cost of goods sold from the total net sales, we have the gross profit or the gross margin. The next section is the operating expenses. Operating expenses includes all general expenses that is incurred by the company. In the case of Apple, we can see R&D, which is research and development costs, and also selling, general and admin expenses, which includes rents, salaries, and so on. When we deduct this from the gross margin or gross profit, we get the operating income. Operating income can also be referred to as EBIT, which is the earnings before interest and tax, and it's basically just the company's earnings from its primary business activities. We also have other income and other expenses. Other income and other expenses are income or expenses that are incurred or that are gained but not related to the primary objectives of the business. For example, other expenses can include when a company has debt financing and it has to pay interest payments. Interest payments is other expenses as it's not related to primary business or activities of a company. When we deduct and add other income and expenses to our operating income, then we have our income before taxes. In the case of Apple, we can see that they have provision for income taxes. This shows the amounts that they're expecting to pay for their income taxes in this period. So when we deduct the provision for income taxes or the taxes paid in a period from the income before taxes, we have our net income or net profit. So that brings us to the end of the income statement. You can see that it just shows how much we made in a period and how much we spent in a period. The balance of or difference between these will give us a net profit or a net loss. Next, we have the balance sheet or statement of financial position. Unlike the income statement that shows us the revenue or expenses of a company over a specific period, a balance sheet actually gives you a financial snapshot of the company. For example, if you look at the balance sheet, we have assets, we have liability, and we have the equity sections. These assets are not just assets that we bought this year or that were bought by Apple this year. They're assets that have been carried forward over years and years, and this is why it's called a snapshot of the financial position at a specific point in time, not over a specific period. But basically, a balance sheet shows you what the company owns and what it owes. What it owns in forms of assets and equity, and what it owes in forms of liability. Still using Apple as a case study, let's look at the financial position of Apple. And I should note that it's written consolidated balance sheets and not just balance sheet, because Apple has subsidiaries in different countries and it is required by law to produce its consolidated financial statements at every point in time. So this is the consolidated balance sheet of Apple. So first we have assets. Assets are divided into current assets and non-current assets. For current assets, they are assets that can be converted to cash within 1 year, while non-current assets or long-term assets are assets that cannot be converted to cash within 1 year. Then we have liabilities. We also have current and non-current liabilities. Current liabilities are obligations that are expected to be settled within 1 year. Examples include accounts payable, while non-current liabilities are not liabilities that are expected to be settled within 1 year. Then this brings us to the final section of the balance sheet. We have the equity or shareholders' equity. Shareholders' equity or equity represents the owner's stakes in the company's assets after deducting liabilities. So basically, it's the residual interest in the assets after deducting liability from the assets. Components of equity or shareholders' equity includes common stock, retained earnings. Retained earnings are actually the amount or profits that are made within a year, not distributed as dividends to investors. So when we make a profit in a year, where do we keep the cash? We move it to retained earnings, and it's a form of equity or shareholders' equity in a business. Now let's move to the third financial statement, which is the cash flow statement. Cash flow statement actually just shows how money moves in, which is referred to as inflow, or how money moves out of a business, and that is referred to as outflow over a specific period in time. If you want to know more about cash flow management, you should actually watch my video on cash flow management that explains how important or crucial it is to monitor your cash flow as a business. Now, still using Apple as a case study, let's analyze the cash flow statement of Apple. First, we have cash flow from operations. It should be noted, however, that cash flow doesn't take into account accrual accounting. If you look at the cash flow from operations of Apple, you can see that the first line we had net income. Then we have adjustments to reconcile net income to cash generated by operating activities. We have depreciation and amortization. As depreciation is not a cash item, and this is why it is being adjusted. What exactly is depreciation and how does it work? Depreciation is the systematic allocation of the cost of an asset over its useful life. Let's look at an example. For example, your company buys an Apple MacBook for $1,000, and that this MacBook will be used for a period of 5 years. And at the end of the 5th year, the scrap value of this MacBook will be $0. So ideally, you have to depreciate this MacBook over 5 years. And since it's $1,000, at the end of the first year, it's $200 should be depreciated. So when you deduct $200 from $1,000, you have $800, which will be the net book value for this MacBook in year 2. So that $200 that has been depreciated is taken into account in accounting, and it's accrual accounting. But in cash flow statement, it's not taken into account, because even though you're deducting or depreciating $200, you are not taking the cash amount out of your company or out of your business or out of the bank. Maybe you set aside so that at the end of the 5th year you can purchase another Apple MacBook for your team or for your company. But that $200 cash is not out of your business. It is still cash in the business. So that's why in the cash flow statements, adjustments are actually made for accrual accounting or non-cash items so that we can derive or arrive at our cash flow from operations. Next, we have cash flow from investing activities. Investing activities typically involve sale or purchase of long-term assets. So, for example, that $200 we put aside from depreciation of our MacBook, at the end of the 5th year, we put aside $1,000, and then we decide to buy another MacBook. You see now, the cash has finally left the bank because we now have a MacBook, and then we'll start the process of depreciation all over again. For sale or purchase of long-term assets, we take this into account in the cash flow from investing activities. Then finally, we have cash flow from financing activities. Financing activities includes debt, equity, or even dividends. So when we take loans, we have cash has come into the company. When equity is being sold, maybe shares were sold, we also have cash because now we've traded our shares for cash. Also, when we pay dividends, cash has left the company. We need to show how this cash moved and how this affects our cash position. So after we add the cash flow from operations, the cash flow from investing, and the cash flow from financing activities, we would have the cash balance for the year. At the beginning of this video, I mentioned that the 3 financial statements are all interrelated and they are linked. First example is the case of depreciation. Depreciation actually reduces the net book value of an asset in the balance sheet. It is also treated as an operating expense in the income statement, and we can see in the cash flow statement we also use it to adjust our net income. Another way that the 3 financial statements are linked is the net income. The net income is gotten in the income statement. When we deduct revenue from expenses, we get our net income. In the balance sheet, our net income is moved to retained earnings if we do not pay them out as dividends, and we can see that in the cash flow statement we actually have to adjust our net income by other non-cash items. We can derive our cash from operating activities. I hope you now understand the three main financial statements and you understand what they are used for and what each of them represent or what they tell you about a company. So thank you for watching this video. If you found it useful, don't forget to give it a thumbs up and also subscribe to Toyasi's Finance Nuggets, and goodbye.